Very good day, my dear students. In this video, you will understand the concept of composite agricultural income and the concept of how to apportion such agricultural income into exempt portion and the taxable portion. And the reason why I am making this video is because certain students have shared the difficulty that they face in understanding this concept, and they also have shared that sometimes they make mistakes in apportioning the composite agricultural income into exempt and taxable portions. Questions have been asked before, and questions may be asked in the future also, so that's why it's important for us to very clearly understand this concept and the method to apportion such composite agricultural income. Now, agricultural income, as we know, is exempt under section 10(1). What is agricultural income is provided under section 2(1)(a). Following incomes, that means certain incomes are listed in this table from 1, 2, 3, 4, 5. So these incomes from land which is situated in India and is used for agricultural purposes is classified as agricultural income and is therefore exempt under section 10(1). Okay. Now, for the purpose of our video, numbers 2, 3 and 4 are relevant. So let's visualize a case where a farmer performs agricultural operations on land situated in India. For example, he grows vegetables and he plucks those vegetables and takes those vegetables in their raw state or in their raw form in the market and sells those vegetables and generates income. So this is income derived from such land by agriculture, okay, and agricultural operations have been performed, and therefore the whole of such income is exempt income under section 10(1). So in this case, the raw agricultural produce has been taken to the market and it has been sold in the market, but this may not be possible in all the cases. In certain cases, the raw agricultural produce may not have a ready market. To make the produce fit to be taken to the market and sold, and for the income to be generated, the farmer may need to perform some compulsory process or processes. Okay, some minimum necessary processing may need to be done before the farmer can make the produce fit to be taken to the market. Okay, for example, let's see an example. Now, Das owns paddy fields, okay, and he wants to obtain rice from the paddy because paddy usually doesn't have a ready market. So Das needs to obtain rice from paddy and then he will go to the market and sell rice. For that, he needs to perform certain minimum compulsory processes or operations. So he needs to carry out certain activities before he can obtain rice from paddy, and these include removing hay from the grain and then chaff from the grain, and further filtering also needs to be done. Finally, rice needs to be packed in bags to make it fit to be taken to the market where it will be sold, and thus will now claim that, okay, the income which I generated should be categorized as agricultural income fully exempt. Now, if you want to argue that no, paddy was not sold in its raw form, in its raw state, and thus performed certain processing on the paddy, and then he obtained rice and then he sold, therefore, since it is not pure agricultural income, it should not be exempt from tax. But this is not logical, because if that be the case, then there are many examples or situations in which the raw produce as such is not ready to be taken to the market, and if compulsory processes are not performed, the person will never be able to claim, the person will never be able to sell the raw produce as such, and therefore he will not be able to take any advantage of the exemption provisions in respect of agricultural income. So the government wants to say this. The government wants to say that if you have performed processes on the raw produce which are in the nature of compulsory process or processes, then also we will make the exempt, we will make the income exempt, and we will treat it as exempt agricultural income. So either you generate income from performance of such compulsory processes, or you generate income from the sale of the produce in respect of which such processes have been performed. So this is number 3 and this is number 4. So such process is also referred as compulsory process. The condition is that only compulsory processing should have been done. Only compulsory process should have been performed. Okay, to that extent, the income will be treated as fully exempt, pure agricultural income. So either in number 2, you take the raw produce, you sell the raw produce and you generate income, it will be fully exempt, or in numbers 3 and 4, you generate income by performing compulsory processes, or you sell the produce on which compulsory processing has been performed. So income derived from such land by the performance of any process ordinarily employed to render the produce fit to be taken to the market is also fully exempt as agricultural income, and such process is referred as compulsory process. Clear? Next, income derived from such land by the sale of the produce in respect of which only compulsory process has been performed is also treated as agricultural income and fully exempt. Okay, but for example, you produce sugarcane. Sugarcane has a ready market, so you always have the option to take the sugarcane direct to the market and sell it, and therefore it will be treated as pure agricultural income and it will be fully exempt. But you decide not to do that way. You decide that you want to manufacture sugar out of sugarcane and then you want to sell the sugar and generate income. Okay, now sugarcane has a ready market, but you decide to manufacture sugar. So you take the sugarcane into the factory and then you manufacture sugar and then you sell the sugar. Now that is not compulsory processing. That is not compulsory process on sugarcane. That is something extra that you have done. So it is further processing. It is processing beyond the compulsory process. Okay, now that will not be treated as exempt under section 10(1). So you are doing this business. Okay, so you produce sugarcane and then you manufacture sugar and then you sell the sugar. What you generate is the business income. Now that business income will be what we will call as composite income. It will be called as composite income because it will have two components. Okay, it will have an exempt component and it will have a taxable component. Income which can be attributable to the production of sugarcane as such will be treated as exempt income, and income which is attributable to manufacturing sugar and then selling the sugar and generating income will logically be or will obviously be taxable as business income. So that will be the taxable portion. So that's why it is called composite income, because once you go beyond the compulsory process and perform additional processes and then you generate income by selling that produce, composite income is generated. Composite income has two components. One is the component which is exempt under section 10(1), and the other component is taxable as business income. Okay, now for that the composite income needs to be apportioned between the exempt portion and the taxable portion. In this video we are going to discuss how the apportionment of composite income is to be done, and there are rules which provide for the method of apportionment. So what we noted is that composite income arises where any process which is other than compulsory process is performed on the produce, and therefore such composite income is business income in nature, and therefore it needs to be apportioned because it is partly agricultural income which is exempt and it is partly taxable business income. For apportionment, two kinds of rules have been prescribed: special rules, okay, and general rule. Special rules apply in certain situations, in certain cases, in the case of certain products. Where a special rule does not apply, general rule applies. So that means if a special rule is applicable, we only need to apportion the composite income as per the special rules. If special rule does not apply at all, then we need to come to the general rule and make apportionment as per general rule. Now general rule is specified under rule 7. So this is rule 7, and it prescribes the method to apportion composite income into exempt income and taxable income in case where special rules do not apply. Clear? Now, taking our example, you are producing sugarcane, and let's say there is no processing which you perform on the sugarcane. You produce sugarcane and in its raw form you take it to the market and sell the sugarcane. So it will be agricultural income and it will be fully exempt. Okay, because no processing has been performed. Even if some processing has been performed, say we saw the example of Das, where he performed some processes on the paddy and then he obtained rice and he sold the rice and he generated income. So if the processes which are performed is are only compulsory process or processes in nature. That means if only compulsory processing has been done, then also, as we discussed some time back, whole of the income will be treated as exempt agricultural income. Composite income will arise when any extra processing is done. So you want to manufacture sugar from sugarcane and then you want to generate income by the sale of sugar. In that case, composite business income will arise, which will need to be apportioned as exempt agricultural income under section 10(1) and taxable business income, which will be taxable under the head PGBP. Now rule 7 tells us the method of how to apportion such composite income into exempt and taxable portions. Now when we talk about computation of of exempt agricultural income, what we do is we take first we take market value or sale proceeds. So in our case, for example, it is sugarcane that is produced. So we take market value or sale proceeds of sugarcane. Okay. Market value, say sugarcane is used to manufacture sugar. So sugarcane is transferred to the sugar factory and then sugar is manufactured. Now when we want to compute agricultural income, we want to take a notional value. Sugarcane is not actually sold in this case, but if the sugarcane was sold, or you can visualize it this way, that sugarcane is actually transferred at a notional value to the sugar factory. Okay, so what we do is first we impute market value. We impute market value. If the sugarcane was taken to the market as such, it will be sold at its market value. Now instead of being sold directly, it is taken to the sugar factory, and therefore what we do, we impute the same market value. Here market value or sale proceeds is given. Sir, what is meant by sale proceeds? Okay, there will be a situation where a person may use a portion of sugarcane to manufacture sugar, and he may sell a portion of sugarcane as such in its raw state directly into the market. So we will take the market value in respect of the portion which we will impute the sugarcane which is used in the manufacture of sugar, and sale proceeds are related to that portion of sugarcane which is taken to the market and directly sold. Okay, so this is what we take first. From that, what we will deduct, we will reduce or we will deduct the expenditure or the cultivation expenses, because these are the expenses in earning this income. Market value, the imputed value, and the sale proceeds, the actual proceeds. Now once we reduce the cultivation expenses, what we get is the agricultural income. Okay, and this is exempt under section 10(1). So this is the exempt portion. Okay, next we figure out what is the taxable business income or the taxable portion. So sugar will be taken to the market ultimately and it will be sold, and we take the sale proceeds of the sugar in the market here. So sale proceeds is what the person earns as a revenue from the sale of sugar. Now from the sale proceeds, what is it that we need to deduct? We need to deduct the actual expenditure. Okay, the actual expenditure. Now cost of raw material or the cost of inputs is what we need to reduce. What is the input or what is the raw material in this case? For manufacture of sugar, it is sugarcane. Okay, so cost will be what? It should be market value. The same market value that we took here, this should be reduced as the cost of input or the cost of raw material. So this is what we reduce here. Okay, what else? Manufacturing expenses. Actual manufacturing expenses incurred in manufacture of sugar, that is a direct cost. So we reduce the manufacturing expenses. So these two elements of cost we reduce or we deduct from the sale proceeds, and consequently what we get is the taxable business income, taxable under the head PGBP. So this is how we apportion composite income into the exempt portion and the taxable portion, right? Now the same formula can be simply be presented in the form of these 4 boxes reflecting the 4 elements that are covered in this formula. Cultivation expenses, market value or sale proceeds of the produce, manufacturing expenses, and sale proceeds. Okay, A, B, C, D. So as we saw, B minus A is the exempt agricultural income, and D minus C minus B is taxable business income. Okay, so this is how you look: exempt agricultural income and taxable business income. Now there is also a different way to look at this to understand this in a better way. So in this whole process, sugar cane is being produced and sugar is being manufactured, and then the sugar is being sold. So what you ultimately get in terms of sale proceeds is this. This is the revenue that you generate from the entire operation, A to Z. Okay. And what are the actual costs that are incurred? Manufacturing expenses and cultivation expenses. Market value is imputed value. So this is not actual because we are using the sugar cane to manufacture sugar. So the actual business income that will arise in this case is D minus C minus A. Okay. B is something that we add while computing the agricultural income, and we reduce while computing the business income. So plus minus gets cancelled. So it's actually D minus C minus A, which is the actual business income. That is what we apportion as exempt agricultural income and taxable business income. And the market value of sale proceeds component is what we add here, and this is what we reduce here. So ultimately, it is the sale proceeds minus the cultivation expenses minus the manufacturing expenses. Okay, this is what we get as composite income, which we apportion as agricultural income and business income. Right? So composite income, as we discussed, is overall in the nature of business income, but then it is apportioned as exempt and taxable portions. This is what you need to be clear. Since it's a business for the farmer, it's business income, right? That needs to be apportioned as exempt portion and the taxable portion. You need to be clear on this particular point. Unless extra processing is performed beyond compulsory process, income need not be apportioned. Okay, this should be very clear. If in the question it is given that there was no processing and income is generated, you should exempt it fully. If in the question you find that only compulsory processing has been done, then also you should exempt it fully. But if in the question you find that extra processing has been done beyond compulsory processing, then composite income will arise, and then you need to apply the apportionment rule. Okay. Now this will become more clear as we deal with this example. Gaurav grows sugarcane and uses it for the purpose of manufacturing sugar in his factory. Cost of cultivation of sugarcane is 10 lakh and market value of the same is 15 lakh. It is not sold, it is used in the manufacture of sugar, but the market value is rupees 15 lakh. If it was sold in the market, Gaurav would have generated 15 lakh as sale proceeds. Now, after incurring 1 lakh in the manufacturing processes, he gets sugar, which is then sold for 20 lakh. Compute the business income and agricultural income of Gaurav. Business income and agricultural income. So agricultural income is what? First, what we take is the market value of sugarcane. Okay. So it is market value minus cultivation expenses. So we take market value of sugarcane and it is given 15 lakh. So we take 15 lakh. From that, we deduct the cost of cultivation. Cost of cultivation is 10 lakh. So we deduct 10 lakh and 5 lakh is what we get as agricultural income. This is exempt under section 10(1). Okay. Now we compute business income. What did we see? Sale proceeds minus this market value minus manufacturing expenses. This is how we get business income. So sale proceeds of sugar is 20 lakh. Okay. 20 lakh. Minus the market value of sugarcane, which is used as raw material in the manufacture of sugar. This 15 lakh is what we take here. And then we reduce manufacturing expenses as well, which are 1 lakh. So what we get is 4 lakh as the business income. So if you look at this, 5 lakh plus 4 lakh is 9 lakh. So 9 lakh is basically the composite income which we have apportioned into 4 lakh taxable portion and 5 lakh exempt portion. How did we get this 9 lakh? Okay. So composite income is 9 lakh because what we got as sale proceeds is 20 lakh. 20 lakh of sale proceeds, sale value. And what we reduce are the expenses, because when we compute business income, we will reduce the expenditure from the sale proceeds. So this is what we do. So it is 11 lakh of cultivation and manufacturing expenses, 10 lakh of cultivation expenses and 1 lakh of manufacturing expenses. So what we do is 20 lakh minus 11 lakh is 9 lakh. This is the composite income. And this is what we apportion into 4 lakh and 5 lakh respectively. So hope now you have understood the concept, okay, of what is composite income, when does it arise, and how do we apply the general rule to apportion composite business income into exempt portion and taxable portion. Okay. Now we saw that special rules are applicable, rule 7A, 7B and rule 8. Now, if special rules apply, we should not apportion the composite income as per the general rule under Rule 7. Okay, we should go by the special rules. And special rules have been made for income from manufacture of rubber, manufacture of coffee, and manufacture of tea, Rule 7A, 7B, and 8. And the reason for creating these special rules is to say that, okay, let's not do the plus minus as per the formula given in Rule 7. Let's not do all this exercise. Okay, let's simplify everything, and let's simplify the compliance process and the computation process, and let's straight away specify a percentage of the portion which will be treated as exempt and which will be treated as taxable. Finish. No need to do plus minus or detailed working. Okay, so for simplification and ease of compliance, these special rules have been provided. And there are certain conditions that need to be fulfilled. For example, in the case of income from manufacture of rubber, sale of these items which are mentioned, okay, obtained from rubber plants grown by the seller in India. Okay, so this is what is being sold, and then the income which arises is the composite income, and 35% will be the taxable business income, and 65% will be the exempt agricultural income. Similarly, for coffee, sale of coffee grown and cured by the seller in India. Okay, so it's not merely the raw produce which is being sold, but coffee is being sold which is grown and cured. 25% will be taxable and 75% will be exempt. Now, in the second case, it is not merely grown and cured, but some extra processing is, some further processing is being done, which is roasted and grounded as well. Okay, so since more processing is done as compared to the earlier scenario, the taxable portion is increased from 25 to 40%, and consequently the exempt agricultural income portion is decreased from 75% to 60%. Similarly, sale of tea grown and manufactured, 40% is taxable and 60% is exempt. So as we discussed, composite income is overall in the nature of business income, and what is apportioned as per this percentage is the composite income. So step 1, you need to first calculate the composite income, and then you need to apportion applying these percentages. Composite income is business income, so therefore it needs to be computed under the head PGBP after allowing all the business deductions, depreciation, etc., which are allowed in computing income under the head PGBP. So step 1, you compute composite business income under that head, and then you apportion into exempt and taxable portions, applying these percentages. Okay. Now it should be clear to us that we need to apply these apportionment rules only when the income is composite in nature. Same for general rule and same for special rules. So if the income is not composite income, it is sold without processing or after performing only compulsory processing, these rules do not apply. For example, if you simply sell the green tea leaves as such, you plug the tea leaves and then you apply some compulsory processing, and then you sell the green tea leaves. So this will not be composite income, and the entire income will then be treated as exempt agricultural income, and these percentages will not be relevant. But when you not only grow the tea but also manufacture tea, okay, then composite income will arise, and then you need to apply 40-60%. Okay. So special rules, they prescribe for a percentage which you just need to apply, and then you need to then apportion the composite income. But in the case of general rule, these presumptive percentages are not applicable, and therefore you need to carry out this working to make the apportionment. So let's take a look at an example in terms of special rules. Ms. Jasmine grows rubber plants in India. She uses the rubber plants to manufacture latex, which is then sold in the market for 40 lakh. Cost of growing rubber plants is 15 lakh, and cost of manufacturing latex is 10 lakh. Compute her total income. Now, total income comprises agricultural income as business and business income, exempt and taxable portions both. It is composite income because latex is being manufactured. Okay, so it is composite income, and there, since a special rule 7A has been provided for, the income will be apportioned as per rule 7A, 35 to 65%. So what we will first do, we will compute the composite business income. So first we will figure out the sale proceeds. Sale proceeds is what? It is 40 lakh. Okay. And from that we will reduce the expenditure. What is the expenditure? Cost of growing rubber plants 15 lakh and cost of manufacturing latex 10 lakh. So what we get is the business income, composite business income before apportionment. It is 15 lakh. Now this 15 lakh is what we will apportion as per the percentage. So 65% will be the exempt portion, 9 lakh 75, and the balance 35%, 5 lakh 25 will become the taxable portion. This is what will be taxable under the head PGBP. So with this we conclude the video. Hope you have understood the concept. If you have got any questions, queries, write in the comment box, or if you have my Telegram or WhatsApp number, speak to me, call me up, or write to me directly, and I will answer your queries as soon as possible. See you very soon in my next video. All the best to you. Good luck and goodbye.